I've sat at the closing table for over 100 business transactions. Deals ranging from $100 million to over $1 billion in enterprise value. As a forensic accountant and M&A director at Grant Thornton, my job was to go inside businesses and figure out what they were really worth. Not what the owner thought they were worth. Not what the investment banker said they were worth. What the business itself was actually worth to a sophisticated buyer with a team of analysts, lawyers, and deal professionals on the other side of the table. And I want to tell you something. In 100 of those deals, I saw the same mistakes over and over. From smaller businesses doing 20 million in revenue to companies doing 500 million. Different industries, different markets, different owners, same mistakes. The owners who built real wealth from their exit had done things right for years before the deal ever happened. The ones who didn't found out at the closing table. And by then, it was too late. I'm going to walk you through exactly what I saw because most business owners in Southwest Florida will never have someone with this experience in their corner. And I think that needs to change. My name is Sean Shakarami. I'm a CPA and former forensic accountant and M&A director and now financial representative with a leading advisory firm here in Naples, Florida. I spent years at Grant Thornton leading deals in the middle market, transactions between $100 million and over $1 billion in enterprise value. My job was called financial due diligence. I went into businesses, pulled apart the financials, and figured out what was real and what wasn't. What I kept seeing deal after deal was a gap between what owners had built and what they'd actually walked away with. And almost every time that gap came down to decisions they had made years earlier, not during the deal, years before it. The exit is just the test. The score was determined long before anyone ever showed up to buy. That's why I made the transition into financial planning, because I wanted to be in the conversation before the deal, before the mistakes get locked in, when there's still time to build something that actually holds value and protects the people behind it. So today, I want to share the 4 biggest mistakes I watched business owners make, the ones that cost them the most at the closing table and the years leading up to it. Mistake number 1, and this showed up in almost every single deal. The owner had never built a real advisory circle. What I mean by that is this. They had an accountant, maybe a lawyer they called a couple times a year, but they did not have a coordinated team of people who actually knew the business, knew their goals, and were working together for the same outcome. In the deals I worked on, the buyers always had a team, a sophisticated, coordinated team of analysts, attorneys, tax advisors, and deal specialists, typically headed by a private equity fund. And on the other side of the table, the seller was often one person figuring out as they went. You cannot negotiate a sophisticated transaction without sophisticated representation. And the same is true for building wealth. The business owners who came out ahead, the ones who actually built generational wealth from their exits, had advisors who talked to each other. Their CPA knew their financial advisor. Their attorney knew their succession plan. Their financial plan was aligned with their tax strategy. Nothing was siloed. Most owners don't have that. Most owners have a collection of relationships that never communicate, and that gap costs them in taxes, in value, in missed opportunities, far more than any of those advisors ever cost them to hire. Mistake number 2, and this one destroyed more deal value than almost anything else I ever saw. The owner was the business. When we first went into due diligence, one of the first things we were always looking for was what happens to this business when the owner walks out the door? Because that's exactly what's about to happen. They're selling, they're leaving, and the buyer is paying for a business, not for a person. What we found over and over were businesses that were entirely dependent on one person. The owner held every client relationship, every key vendor contact, every institutional knowledge about how things actually worked. None of it was documented and none of it was transferable. A business that cannot run without you is not a business. It's just a job. And jobs don't sell for 10. The moment a buyer realizes the revenue is tied to the founder's relationships, the valuation drops dramatically. The deal structure changes. You go from getting a clean check at closing to an earnout that ties you to the business for another 3 to 5 years, hoping the numbers hold. I watched owners who thought they were going to walk away with 8 figures end up in an earnout structure still grinding away at the business they thought they had just sold, because they never built something that could exist without them. If you own a business, the most valuable thing you can do, starting today, is build systems, document processes, and develop the people around you so the business runs well, whether you're there or not, for the exit, for the value it creates between now and then. Mistake number 3, and this is one that nobody talks about. I'm going to say it plainly. Owners who ran cash through the business improperly, paid personal expenses through the company, kept things off the book to save on taxes, they thought they were winning. They thought they were being smart. In due diligence, we find it all. Every personal expense run through the business, every cash transaction that wasn't reported, every arrangement that was designed to minimize what showed up on the financials, we were specifically trained to find it. And when we did, the deal either died or the valuation was slashed. Saving money under the table cost you multiples at exit. For every $1 you think you're saving today is potentially $5 to $10 that you don't get at the closing table. If your business is valued at a 5 times EBITDA multiple, every $100 to $1,000 in earnings that isn't by the book to save maybe $20,000 or $30,000 in taxes has just cost you $500,000 in exit value. The math never works in your favor long term. The businesses that sold cleanly, that got top dollar, that closed without drama, had clean books, transparent financials, nothing to hide. And that transparency was built over years, not weeks before the deal. If you're a business owner and you've been cutting corners on the financial side to save money on the short term, I want you to hear this clearly. You are not saving money. You are borrowing against your own exit value. Mistake number 4, and this one hits me the hardest because I saw it happen to people who had done everything else right. They closed the deal, they got the check, and they had absolutely no plan for what came next. The business had been their identity, their structure, their purpose, and now it was gone. And sitting in front of them was more money than they'd ever made in their life, with no framework for how to protect it, grow it, or make it last. I watched people who worked for 30 years to build something, walk away from a successful exit, and make catastrophic decisions in the following 18 months. Bad investments, lifestyle inflation that outpaced even a significant liquidity event, tax bills they weren't prepared for because nobody had planned for the structure of the deal. The exit is not the finish line. It's the starting line for a completely different financial life, and most owners arrive there completely unprepared. The ones who navigated it well, they had someone in their corner before the deal ever happened, someone who understood both the transaction side and the wealth side, who would help them structure their personal finances in parallel with building the business, who was ready on day one after the closing. That's the gap I'm trying to close for business owners here in Southwest Florida. Not just the financial planning piece, but the bridge between what you're building in your business and what you're building for yourself and your family. Let me bring it together. Over 100 transactions, hundreds of millions of dollars in deal value, and the same 4 mistakes showing up again and again. No trusted advisory circle, a business that couldn't run without the owner, financial shortcuts that destroyed value, and no plan for the wealth that came after. None of these things are inevitable. Every single one of them is fixable. If you address them before you're sitting across from a buyer, before the due diligence team shows up, before the clock is running. The best time to build a business that creates real wealth is years before you plan to sell it. The second best time is today. If you're a business owner in Southwest Florida and you want to have an honest conversation about where you are and what it would take to build something that actually holds its value, I want to talk. My initial conversations are free and private. No pitch, no pressure. Just a real conversation with someone who has been on both sides of the table and who genuinely wants to see business owners here in Naples and Southwest Florida build the kind of wealth their work deserves. Just drop a comment, interested, or email me directly at thenaplescommission@gmail.com. And if this video was useful to you, subscribe. I put out content every week for business owners and high earners who want to think more intentionally about their financial future. I'm Sean Shakarami. This is the Naples Commission, and I'll see you in the next one.